Alrighty guys, so in this video we're going to be talking about the classic ICT buy model, and we're going to use an example from 2 days ago, Tuesday the 25th of June. With that being said guys, let's get straight into the video. So when you're looking at this classic buy model, it's essentially a really big power of 3 move. And there's a very clear example of that here. Like we've got accumulation, manipulation, distribution, but I want to go into the finer details and also label all these elements out. So if you want to look for this in the markets yourself, you can approach that in this way. But more importantly, let's take you through how you can actually execute using this larger framework just on the 15-minute time frame, and then applying that to take an entry on the 1-minute time frame. Let's get into it. First and foremost, I'm going to mark out the midnight open price. So what I'm going to do here, I'm going to zoom in and I'm going to look for the midnight open price. Midnight open price, let's have a look, somewhere around here, right? I'm going to mark that out across. And what I usually do is I'll label this with a gray color. It can be whatever you like. I just personally use the gray. What you want to see for this model to play out is you want to see accumulation at or around midnight open price. And you can see, even if you look back previous days, look what price has been doing for days and days and days and days. We've been accumulating, we've been sticking to a really tight and narrow range. So essentially all of this here, that is all accumulation in my opinion. All of that, right? Accumulation. What do we do after we accumulate? We manipulate down. Now the really important thing here is that you've got to have a look at what happens at midnight open, and then have a look at what happens during key sessions, during macros, during kill zones. So what I'm going to do is I'm going to mark out another factor, which is the London open session. And London open session is from 2 o'clock to 5 o'clock in the morning. So these two lines, that's 2 o'clock in the morning. And this line here represents 5 o'clock. Now, it's not a coincidence that the low of the day is formed during this London open session. And this is the whole point of the buy model that we talked about here, the classic ICT buy model. It's all about the low or the high of the day forming during the London session. And you might have heard people talk about that before. This is all it is, right? But there's more to it than this. Obviously, this is on a larger time frame. Let's look at this time frame to start, and then let's zoom into the smaller time frames, having a look at key sessions, having a look at silver bullet, having a look at macros, and how you could phrase high probability trades on the 1-minute time frame, both in the London session and also the New York session, with the same narrative that price, once it manipulates, probably wants to go back up to sweep that buy side liquidity. So let's get straight into it. So we've marked out midnight open, we've marked out the first kill zone. Now I want to see what we have over here. Now this is really interesting. So if I zoom out guys, have a look at what happens here. Look at this massive void in price. And this was around the same time we changed contracts, right? Now we're using NQU, or you might be using NQ1 for futures. But look at this massive void, and what I want you guys to do is grab your Fibonacci tool, you can go on your charts too, and measure out that void liquidity. Measure it out, get the 0, get the 1, and mark out the halfway point. Now, if I just do this perfectly, as perfect as I can see, what is very interesting here is how we actually respect the halfway point of this zone. Almost perfectly, like almost to the tick, we respect that halfway point of that zone. What does this mean? What does this mean? These are little price signatures that you're looking for, right? These are little price signatures that you're looking for. Anytime price respects almost perfectly the 0.5, the 0.25 levels of different PDRAs, different zones, you have to make note of that and you have to mark that out. So we respect perfectly this 0.5 zone. And in doing so, look what price does in that zone. If I just mark this out in red, we actually have a sweep of sell side. Right, so have a bit of a look, I'll zoom in. We can see, right, that this wick here sweeps this level of sell side. And the really important thing to consider here, guys, is did we displace through this swing low, or did we reject from that swing low? That is how you tell the difference. By the way, I'll make another video on this, but that's how you tell the difference of a sweep of liquidity or a continuation. How aggressive are we trading around that zone? Are we displacing through? Are we rejecting from? Those are the two things. Are we displacing through, or are we rejecting from? So what happens for the rest of the day, guys? We push up, we accumulate, we then sweep more sell side liquidity, right? This is on the 15-minute time frame. We push up again, trade back down into the range, sweep more sell side, push up again, and ultimately that midnight open price acts as a magnet. But ultimately these two swing highs, which are relative equal highs, that are a part of that original accumulation, they act as the draw on liquidity. So on a 15-minute time frame, you can see how this structure plays out. You can see how the market moves, and you can see how during this key window here from 2 o'clock to 5 o'clock, it initiates that reversal. The London open session forms that low of the day, And then from that point, any move down is just to sweep liquidity and to trade back into the range to give the market more energy or more fuel to move in the upwards direction. So if you'd like, this is the narrative that price has manipulated down only to move back up. It's left accumulation here, which could be a market maker model, right? Original accumulation. That original accumulation also has two relative equal highs or equal highs, which makes that a really, really nice draw on liquidity, which is important. So let's consider all these factors and let's talk about how this model is played out in totality. And we'll get into the actual 1 minute time frame now, just so we can zoom in and see what happens around these key time frames. So let's get straight into it. On the 1 minute, let's go back into replay mode and let's go all the way back here, right? Let's go all the way back here. Now, what I want you guys to have a look at, if I was to zoom in into this price segment here, right? Have a look and let's go into the 1 minute time frame. Now, we know, right, this red line is the previous day low that we marked out on the 15 minute time frame, which is important. Let's see how we trade when we sweep that swing low, right? So again, we're looking in this gray box, price comes down, comes down, comes down. We sweep that low. Now, the question for you, this is on the 1 minute time frame, do we sweep and reject or do we sweep and continue through? We sweep and we continue through, right? So in this case, that is called a liquidity sweep. It's called a purge liquidity, a ray liquidity, whatever you want to call it. And after sweeping that liquidity, we immediately displace back up into the range. That tells me that price wants to potentially move higher. Another factor to consider, guys, is when does this happen? It happens not only in the London Open session from 2 o'clock to 5 o'clock, but it also happens, if I just draw this out, from 350 to 410. So during this macro, 350 is right here. Let me make that a solid line. And 410 is right here. So it's not random. These silver bullet times, these macros, these will offer important price action points where you're expecting something to happen. And if it does happen, you can execute on that. So you can see how finally, look, we wick into that swing low, we displace back up into the range. You can see at the bottom here, that's roughly about 4 o'clock. And when we displace back up into the range, we create so many PD rays that are now supporting our idea that price wants to move higher. What do we do here, guys? When we close above the opening price of this candle, if I was to mark this out, right, the opening price, that indicates there what's called a change in the state of delivery. Now, you might have heard people talking about this, a CISD. All that is, guys, is where the down close candle or the order block is created and the opening price gets closed above. That's it. That just indicates that price might want to reverse. The second thing you have here is you have a swing high that's broken to the upside. That there is your market structure shift. So a lot of people are confused, between what's a market structure shift, what's, a change in the state of delivery. I hope that kind of explains the difference. That there's a change in the state of delivery. That there is a market structure shift. Both occur, but the change in the state of delivery occurs before the market structure shift. That makes sense. So number one, number two, we've also formed a bullish fair value gap right here, right? What that signifies that price really wants to move somewhere, right? If we're creating a bullish imbalance, a buy side imbalance, a sell side inefficiency, price is really wanting to move up. And last but not least, we have this bearish fair value gap. If I was to mark this out, right, we disrespect that with this up close candle. So I'm going to label that in orange, right? So that's our inversion fair value gap. This here is our bullish fair value gap. We've got a market structure shift. We have a change in the state of delivery, which is important. And from there, we've got targeting high prices that we want to see. So realistically, when you're looking at this, guys, you might say, well, how do I know it's going to reverse from this point? How do you know? You use the macro, you use time, and you use price. So we've just swept an important point of sell side liquidity. We've just tapped, which is this black line here, into the halfway point of that void, that gap that we saw on the 15 minute. And we're in a macro, and we're in a key session. And the important part is that we've got all of these highs to target as buy side liquidity. So if I was to mark this out, everything here in blue, guys, and there's more too, all of these swing highs, they offer buy side liquidity objectives. So you're not short, right? You're not short of targets. We've got heaps here. We've got heaps to target. Price can take out this high, this high, this high, this high. Every single swing high here is a target. And then you've obviously got two relative equal highs up here. There's so much to target. Now, watching what price does, look at how quick and how aggressively we trade up after sweeping that liquidity, after displacing back into the range. Have a look, right? Aggressive. We trade up. Small pullbacks, but ultimately every single accumulation pocket here is met with an expansion higher. And you expect this. Why would you expect such an aggressive move to the upside after sweeping this liquidity? You've swept a previous day low. So if you ever sweep previous day lows, previous day highs, you can expect a really aggressive reaction, especially when guys, you have many low resistance buy side liquidity points. I think it's really important to mention. What is low resistance liquidity? In this case, it's similar if I was to draw this, right? If I was to draw something out like this, and we'll get it up here for you guys. If price is stepping down like this, we're forming lower highs, lower lows. All these highs here are points where people are going to trail their stop loss. Therefore, there's money or liquidity resting above those points. What's the market want to do? The market only targets two things: liquidity in the form of fair value gaps or swing highs and swing lows, right? So liquidity is at swing highs and swing lows, and imbalances in terms of fair value gaps. So it's really important to keep in mind that when you have this low resistance liquidity and you're in a macro and you've just swept important liquidity and you've reacted from a key point, the 0.5 level of that void of liquidity, you can expect these moves to pop. And unfortunately, in this case, this is where you need to understand advanced market structure shifts and be able to apply inversion fair value gaps. If you're waiting for a return to this bullish fair value gap, do you get that? No. All that means is that this now becomes what ICT calls a breakaway gap. And a lot of people ask me, okay, well, Ruben, like, what is a breakaway gap? How do you know it's going to form? When would you expect it to form? Those are probably the questions that you do have. And they're great questions. Let's go through all of them. How do you know it's a breakaway gap? Once you break past the next major swing high without returning to it, it becomes a breakaway gap. How can you anticipate a breakaway gap to form? If you're in a key session, in a key time frame, and you've swept important liquidity, and you just had a shift in structure, and there's a clear draw on liquidity, like heaps of low resistance liquidity, if price is really bullish, why should price return? You'd want there to be inefficiencies. You'd want price to be running quickly. So each time you create one of these gaps here, look at this. Each time you create one of these gaps and you fail to actually come back into that, that just tells you that the market is really bullish. And you expect that. Why do you expect that? Because we've swept important liquidity during a key time frame, and we've got important liquidity to target. So you want price to really pump and push up to that buy side. And you can see ultimately, we push up, we push up, we push up, we push up. And this is how you take advantage of it during the London Open session. A lot of people are going to come to me and say, well, Ruben, I don't trade the London Open session. How do I, take advantage of this move if I want to trade, the New York session, for example? Well, let's get straight into it. Now, I just want to make a quick note, guys, that this day here was Tuesday, right? So the midnight open price on Tuesday is here. We can also use the previous day's midnight open price. So I use a couple of days before, right? Same with NDOGs and NWOGs, new day opening gaps or new week opening gaps. You can use those from previous sessions or previous days. And some people mark these out, and that's what I've marked out here, right? So now let's talk about the New York AM session, how you can phrase a trade during that session. That there is your London session trade, and that is the low of the day. So that could be something you hold all the way for the rest of the day, right? You don't have to, but you could if you're a swing trader. Now, what I want to focus on is probably this segment here, because this is where you actually have, right? This is where you have the New York Open session start, right? New York session T 9:30. This technically here is the PM session 2, which could be applicable as well. And both offer opportunities, but in my opinion, once that midnight open is purged, that becomes your first draw. Your second draw, these two equal highs, which happened in the second London session. We can talk about that, right? That's yesterday. So realistically, let's zoom in to this price action right here. Let's have a look at maybe the 9:15 candle. Let's mark out this swing low. Let's go back to the 1 minute time frame. Let's play price out to see how we can phrase this idea and how we can phrase this trade. So price forms a swing high here. It forms another swing high here. Let's see what happens. 9:30 is almost coming, right? 9:30 is almost coming. Notice how we've formed two relative equal highs there. It's really suspicious, by the way. Now, right here, what's happened here? We've swept sell side liquidity. 9:30. Let's see if we create any sort of inversion fair value gap. Let's have a look. So that there could potentially be an inversion. Let's see what price action does. Right away, that indicates price wants to move higher. Now, let's assume that you don't trade until 9:50, right? We'll play price out. Now, we sweep those highs, right? We sweep those highs. But we still have this line, which is midnight open price from the previous day. We still believe price could continue up. Why? Because look at all this accumulation. Look at all these highs here, this low resistance liquidity. It's normal for London session to move a little bit And if it expands, AM session can also expand or it could accumulate. So we're keeping those in mind as we're trading. But let's see what price action does now. Now what I might do is I might mark out the macro, and this will be really interesting for you. I might mark out the macro from 950, right, to 1010. So we still believe price is going to go higher. Let's have a look from 950 to 1010. Can we phrase a trade around that time frame? Let's see. All right, cool. So notice how we've swept this sell side again. Look at this. We've come up, we've swept sell side. If we grab our OTE range, we go from this low to this high. And that was to mark out these two ranges, guys. We dig below equilibrium, we just tap onto OTE, we sweep some sell side liquidity, and we tap back into this bullish fair value gap. So potentially it could be an opportunity to go long from here. Let's see if price wants to push up from this point. And this is obviously the AM session macro, the first macro of the day. There we go. Now you might say, well, there's no entry there. There's nothing to look from. Let's have a look at a smaller time frame. Let's go back. Because sometimes I wouldn't be afraid of the smaller time frames, the 30 second, the 15 second, because these things can be really beneficial when you're looking at taking trades. So have a look here. That's the 30 second, and look at the 15 second. Let's have a look. Cool. Now notice what happens here with price. Everything is fractal. That there's your 1 minute bullish gap. We've swept that sell side. What's this, guys? BPR and also an inversion fair value gap. So we create a balanced price range. We dig back down into this bullish fair value gap. There should be no need. There should be no need, right, for price to come back down. Why? Because this swing low is swept liquidity. This should be a protected swing low. All of these swing highs here, number 1, number 2, number 3, that is all low resistance. So your trade could look something like this. Set a limit order, stop below the low, TP at those highs, and happy days. That is over a 1 to 2 risk reward. Yes, it's the 15 second chart, but time, guys, is fractal. It's fractal. And again, we do come back again and tap into it. What do we do in that 15 second chart? We come back again, we sweep that level of sell side. What do we do, guys? We react after creating this inversion fair value gap. And that there, again, gives you that opportunity to go, okay, price might want to move higher. You could do the same thing here. You could go for a long right here, stop below that low, right? Target that swing high for a partial. If you want 1 to 2, go for a 1 to 2. Whatever price wants to give you guys, you can take that. It's really important. But there has to be a framework behind that trade to take advantage of it. You're not always going to get the chart on the 1 minute time frame giving you a clean entry. And that's why sometimes I'll utilize the 15 second chart or the 30 second chart. But you need volume to do this. So it starts honestly all the way back here, seeing what happened during the London Open session, seeing that now we've accumulated here, we've manipulated down, and we've left buy side targets. And then looking to see how price is fractal, like it's all fractal. We sweep this sell side, we sweep that sell side, react. Then on a smaller time frame, on the 15 second, we sweep that sell side and react. It's all fractal, guys. So I wouldn't be afraid of using small time frames, but use those for those really fine entries rather than for every single trade. You know, if there's something on the 1 minute, take it. But if price is like doing this and it's accumulating quite a bit, the chances are that the smaller time frames are going to offer the best opportunities, and you won't get an entry on the 1 minute, right? Unless you're entering off maybe an order block or a breaker, it could be very hard to, you know, phrase a trade or to get an entry that you really like. So hopefully I'm putting these concepts together for you guys. You've got to start in that higher time frame. For me, the 15 minutes is sufficient to create a bias or to create a narrative. That's completely fine. 15 minute tells you where price wants to go. You execute based on that. Realistically, even if you didn't have the 15 minute time frame, even if you didn't have this classic buy model, right, where London sessions form the low of the day, you can still execute a trade to push the price higher. That's completely fine, because this macro, look what it does. It runs up for liquidity. So you could see this as a sweep, an inversion, or a retracement back down and target these relative equal highs. That could be something you see as well. So every single trade idea might have different ways that you approach it, right? Different ways you approach it. And if you've made it this far, one other thing that I've left now to the middle of the video is these swing lows. If I go to a 15 minute time frame, there's actually SMT at these swing lows, right? So if I was to mark out these two swing lows here, you can see the NASDAQ formed lower lows, but let's have a look at the chart for ES and let's see what ES did. So 15 minute chart for ES, have a look, right? If we go back, and let's get those side by side so you guys can see. Look at this, ES formed higher lows, right? And we can use these as well. So these are the actual lows here. ES formed higher lows, the NASDAQ formed lower lows. What does that suggest? Smart money divergence. The pairs that are meant to be correlated are now not correlated. There might be a reversal. The fact that you see that on a 15-minute is also another good sign too. So again, the higher time frames obviously hold more weight than the lower time frames. You're not just going to look for any random, market structure shift on the 15-second. But if you want to narrow down your entries, and of course the 15-second, the 30-second, the 1 minute can be good, time frames to execute from. And seeing this on a higher time frame, seeing this SMT at a key level, right, which is the 0.5 level of that void, that's the first thing. During a key time frame, during a macro, during London Open session, and then seeing the reaction after sweeping that sell side on the Nasdaq, it's just perfect. Everything lines up because you can see every move down here has been quite aggressive. And for so long, we've been building. It's due for some kind of retracement. When can that retracement happen? When price digs back down into a high time frame key level, and when there's SMT divergence between normally correlated pairs. In this case, ES on this chart, and then Nasdaq on this chart. So I hope you guys got something from that video. It's really important to put these things together. And I think what I might start doing in these videos, I might do a summary at the end of the video for those that actually stay to the end. So what are you looking for a classic buy model? And let's get this up. If you're taking notes, you can take some notes like this. Let's jot down some notes. So number one, you're looking for, some accumulation, and ideally you're looking for that at a midnight open price. That's the first thing. The second, you're looking for some manipulation into a higher time frame key zone. What could a key zone be? It could be a fair value gap, it could be a void of liquidity, it could be an imbalance of some sort, right? It's one of those key things. Number three, you're looking for London session to form the low or the high of the day. Now that low or the high of the day should be formed ideally using SMT, right? That's really important. And ideally in a key time frame, right? Silver bullet or a macro, keep that in mind. Number five, you need to make sure you have a clear target on the run up to the ultimate target, which are these, relative equal highs here. And number six, every pullback, right? Every pullback in price, you fade that pullback. So every pullback in price you treat as a Judas swing. So every pullback here you treat as a Judas swing, pullback here you treat as a Judas swing. Every single time we pull back, you treat that as a Judas swing. These are the notes that I'll be writing down. I'll be marking on the chart yourself. Again, if you have any questions, guys, feel free to leave them in the comments below. And until next time, I'll talk to you then. Peace.